All right, Dwight, are you going to let them in?
Hey, Mark. Yeah, they're coming in right now.
Okay. Hey, everybody. We'll be starting this in just a moment. John, thank you as always for attending. We've got a lot of Pattern Trader members on these series, so always good to have you. Hey, Garen. We've got Algimontes from Tenerife, so some exotic locations. Enda, hello. Ollie, Marlene. So a lot of regulars. We always have a lot of our returning members on these things. So somewhat of a validation, and thank you very much for your support. For all of those you are new to this, hopefully you'll get a lot of value and input. So we are right on the hour, or half hour rather. I'll give this another 30 seconds. Tamid says he's new. Hi, Tamid. Nice to know you. Humberto from Portugal. A lot of people I know want to either visit or relocate to Portugal, Humberto. So it sounds like a lovely area of the world. I've got to make it over there. Simon, how are you? Christian from Manchester is also new, so welcome. John Powell, welcome. So I'll give this another 10 seconds and then we can get cracking. Michael from Manchester, got Johan from Belgium. So a lot of exotic locations around the world. It always gives me a great kick to see the viral nature of communications today. Dave from London, Robin from South Wales. So again, a lot of exotic locations. So good evening and welcome to this 3-day live trade execution webinar series subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shawson, the Pattern Trader. Now we have a ton of our current members on these presentations, but there's a lot of you who don't know me, are new to the Pattern Trader, maybe new to trading, and just want to talk a little bit about my philosophy and a little bit of the background. So what I'm going to do is play you a tape. Now, sometimes people say, well, I thought this was a live event and what have you. This is going to be a 10, 12-minute tape. If you've already seen it, you can go grab a cup of coffee. But we're going to play like a 12-minute just introductory tape. And then I will come back and I will go into the live markets. So with that said, Dwight, you can tee up the video, and after it's done, I'll come back and we'll go into the markets live. I also put a strategy booklet in the chat box. Gives you an insight to my strategies, the price patterns I look at, and the scientific validation behind them. So again, I'm going to play a very short introductory video, and then I'll be right back. Welcome to this 3-day live trade event subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shawson, the Pattern Trader. So we have so many of our members on this webinar. It's great to see the support that we have continuously turned out from our members. And for those of you who are new, let me just briefly introduce myself. My name again is Mark Shawson. I started the Pattern Trader in 2015, basically to educate people on how to recognize price action and price patterns. So I'm often asked the question, do I trade on the news? And the short answer is no. And I'll go into that in a little bit. Price is a discounting mechanism. Price is ahead of the news. Everything is filtered into the price. And so I just look at the price action on every asset class. So it doesn't matter if you're trading crude oil or pork bellies or the euro versus the yen or IBM stock or gold. You can use all of the technical analysis that I'll be talking about over the next several days. I started this business many decades ago when I was in college. I was going to one of the best business schools in the country, University of Southern California out in Los Angeles, and studying how to make investment decisions on what we call fundamental information. So fundamentals are when you look at a company and you break it apart and you look at the price earnings ratio, you look at the sales to, inventory ratio, you look at the management. If you're looking at a cocoa market, you're looking at exports, you're looking at the dollar. So you're making investment decisions based on what we call fundamental information. But to me, the markets are a forward-looking mechanism. The markets are always looking ahead. And so even if you can see information today, the market is not looking at what the information is today. It's looking at what is the information going to be next week, 3 weeks from now, 3 months from now. And this is why I study price and price action. So again, my abiding philosophy is that price is a discounting mechanism. And what does that mean? It means that price is effectively ahead of the news. I'm going to show you some charts where for a year and a half, I was predicting that Tesla was going to fall from $1,200 to $400, that it was basically going to drop by 3/4. And that's exactly what we saw last year. Now, Tesla was adjusted. It was split 3 times. And so it's trading at about $100 now, and it fell from $400. So Tesla was down 70% last year. Now, I was saying to our members for a year and a half prior to Tesla collapsing at the end of the year that this was going to happen. Now, how did I know that? The only way I could know that was by studying price, and price is ahead of the news. So we can say that, Tesla crashed because Elon Musk took over Twitter, but that was only late last year. The price patterns and the price action was telling us that Tesla was going to crash, and the reasons always come out later. The why is not important to me. To me, it's where, when, and how much do I have to risk on any given position. So to me, amateurs trade stories, but price is the only truth. When we talk about stories, I remember looking at CNBC one day, and Kevin O'Leary, Mr. Wonderful from Shark Tank, was, telling us about Zoom. I was short Zoom, and it was right before the earnings. And Kevin O'Leary came on and said, you've got to think of Zoom as a new telco, a new paradigm, a new way of communicating. And so I was short when he was saying, this is, just a new paradigm. And, this is the conflict. When you look at news, you get you get confused. So this is why I say you have to be objective. There are all kinds of information swirling about the investment markets today. How hard's the Fed going to go? Are we going to have a recession? If we have a recession, is it going to be a soft landing or a hard landing? What's going to be the terminal rate? When's the Fed going to pivot? We've been hearing that conversation every hour, every day, every week, every month for the last 3 months. And you cannot make objective trading decisions based on listening to that. So there are going to be all kinds of things buffeting the markets this year, the Fed, recession. And so you have to be entirely objective. So to me, price action is the analysis of price charts, and it helps us define 2 things: objectively define where to enter a position, and then objectively identify levels to manage your risk. And that's the holy grail of trading. If you know where to enter a trade and what your risk is, you've got a good deal of this game beat. So to me, the advantages of price action is that price action tells us where on the charts to buy or sell without second guessing ourselves, how to establish optimal entries and exits, and how to protect your account and maximize your profits. And by using price, you can diversify and trade in bull or bear markets, trade markets that are going up, trade markets that are going down, and you can trade any asset class. So you don't have to have specific fundamental knowledge on how a treasury bond works or how the euro yen works. So you can diversify across foreign exchange, stocks, gold, oil, commodities, in whatever you want to trade. If it has a high, low, and close, I can trade it. So I basically put together a few thoughts on how to achieve consistent profits over time. Obviously, putting on a trade is effortless. We all have screens and fancy technology, and it's fun putting on trades. But it's all about having the discipline. And what I try and do is hone in on the best risk to reward opportunities. Those opportunities that have a 3-to-1 risk and reward. And that means if you're going to risk $5 on your stock, you should see a pathway to make $15. And you can lose a lot of trades if your risk reward is 3-to-1. Now, to me, the biggest problem in trading is discipline and being unemotional. And I struggle with that. So I've kind of built this rule. I built the framework for the pattern trader really around myself to help myself give myself governing principles to keep myself out of trouble, because I will trade a 5-minute chart. I'll trade a 1-minute chart. I'll trade a 4-hour chart. But to me, I feel if you stick to the longer term timeframes, daily, weekly, monthly, this will give you bigger moves, bigger outcomes, and eliminate all the ups and downs. Now, I've also found that either buying immediately within the first 15 minutes of a market opening or on the close is the way that I have found that, avoid all of this emotional intraday trading. And intraday trading is just gambling. When you're looking at a 15-minute chart, a chart can go anywhere in the next 15 minutes. Yes, you can spot double tops, double bottoms, and all the things that I look at. But the thing is, they won't sustain on a 15-minute chart in the same way that they'll sustain on a weekly chart. And also, I think that we're all humans. We're not bots. So I try to limit my trading to no more than 3 positions at any one time. I can't keep track of all of these things. And certainly when the market starts swirling around, it's very, very difficult to keep track of it. So the idea is to find the best trading opportunities with the best probabilities. It's not quantity, it's quality. And then it really comes down to risk management. If you protect your risk, and especially in the FX market, if you limit your risk to 0.5% per trade, you can lose 10 trades in a row and only be down 5% in your account, where most people are trading too much and risking too much on each trade. And it's all about controlling the risk. So at the end of the day, it comes down to being in control. Wait for the market to come to you. If you find you're chasing trades, if you feel like you've missed something and now it's going and now you got to jump in, you can feel very quickly that you're out of control, that you're in a reactive mode. So to my mind, the way trading should be is that you should anticipate, understand what the market's telling you, understand the price patterns, and anticipate where prices are going to go. If you find that you're reacting, this is where things are likely to go off the boil very, very quickly. So if you follow these principles, there's no reason that you won't be hugely successful. And that's what I try and do at the Pattern Trader, is give you the education and give you the tools to become highly successful. We have a Trustpilot page that you can go and look at all the testimonials from hundreds of our members around the world. So it really boils down to a 4-step trading methodology that has taken me decades to figure this out. So the first thing, when I open up a chart, I want something to jump out at me. If it doesn't jump out, I just move to something else. So when we open up a chart, basically what I want to see is this market going in one direction or another? Is it in an uptrend, or is it in a downtrend, or is it just a sideways channeling market? Now, there are 2 other variables to an uptrend, downtrend, and sideways market, and that is a market that is turning. One that's turning from a market that's been bullish to one that's bearish, or turning from a bearish market to a bullish market. And frankly, that's where I make a lot of my money, on the turn. Today, the Dow Jones went up and started turning lower, and I made all kinds of money on that turn. I'll show you what I did in just a moment. So the way I identify a market that's going to turn is that there's always what I call a governing price pattern. Before a market turns, there's a price pattern, head and shoulders, a double bottom, an inverted head and shoulders. There's always some price pattern that precedes that turn. And then I try and corroborate what I feel like I'm seeing in terms of the pattern with what I call the price action. And there are two forms of price action that I've coined an insurance bar. An insurance bar can be on a daily chart, a weekly chart, or a monthly bar chart. And they come in two forms. One is a key reversal. And again, I'll discuss this in more detail. And this is what we saw again today in the Dow Jones. Dow Jones made a new high, close on the low. That to me is what I call a key reversal, where it goes higher and closes on the low of the day. Another form of an insurance bar is an inside bar. And I'll show you a chart today with an inside bar that I think is a tremendous signal going into tomorrow. So once I kind of identify the trend, then the chart pattern, and then I drill it down to a certain day where there's a turn, a key reversal, or an inside day bar, then I look to confirm all of this analysis. So all of this analysis is really very subjective. It's my way of looking at things. And ultimately, I want the market to confirm what I'm looking at. So my philosophy is the market is always right. I'm right some of the time. The market is always right. So I'm always looking for the market to confirm what I'm thinking. And so if I'm looking to buy a market, I'll put a buy stop slightly above the high of today's range. Or if I'm looking to sell short, I'll put a sell stop underneath the inside day bar or underneath the key reversal. And I'll go into this in real time. Hopefully this will make more sense as we go along. So these were some of my predictions in Tesla, going all the way back to January of last year, where I started talking about Tesla as an implosion. And this was when Tesla was still trading at the very highs of its trading range. So now Tesla has split 3-for-1 since this time. So it's, basically on a split adjusted basis, it would be trading at $300. But Tesla's trading at $100 in the market. So it's gone down 70% since I started telling our members to sell Tesla. And all through the year, I was saying short it at 1,000, short it at 800. Even, the end of last year, where it was trading at $187, this was in November. A month later, Tesla dropped to $100. So you could have made almost 100% just on that one signal. Okay, so we're back, and I don't know if you guys had any questions. Mark Joey says, I've been following you for a while now, and you've sent numerous emails requesting to join, but I've not received any response. Okay, just send a message to support Sipiwi. Sorry about that. I think I went to the wrong chat book. So all good for me, Umberto. So I'm going to spend the next couple of days exploring and exposing you, if you will, to my way of looking at the markets through the prism of price action. And again, it goes back to the question, do I trade the news? And the answer is no. So tomorrow we have Chairman Powell going to speak. Everybody's anticipating that it's going to be very bearish. He came out last Wednesday. He sent some codes out. He looked very relaxed. The market took off. And then, tomorrow, I guess he's going to come back and, talk tougher again. But, we have to look at the phase where the market's in. Depending on what, if the market's in a bear phase, it will absorb bearish, bullish news and the sell-off anyways. If a market's in a bull phase, it'll take bearish news and it will buy that up. So let me kind of just go into, I always talk about the positions that I have and why I took them. And then, as it turns out, I've been very kind of, have not been doing much activity at all. I think the markets are in this transition phase. I still think that the markets took off. They're bullish, but they've sold off the last couple of days. I imagine with Powell tomorrow, maybe we'll get another sell-off, and that may be a buying opportunity. So on Friday, you can see this was the third. This was on Friday. I bought some puts in Apple in anticipation of a down move in Apple. And today Apple fell $3 and I closed these puts out for about a 40% gain. Similarly, I bought some puts, and a put is a bet. It's a leverage bet on a decline in whatever instrument. So in this case, I bought a put on Apple, which is a bet on a move lower, and Apple came in $3 low.
Hey folks, looks like Mark is having some internet issues. He'll be working on it, so hang tight.
Like,
Hey, Mark.
hey, my computer crashed.
Okay. Well, we have some very patient campers here. Most people are here.
Wow, that's awesome. Am I back live?
Yep, loud and clear. I'm just going to restart the recording.
Hey guys, I am very sorry. We had a brownout in this area, and it takes me forever to get back up and running and get my programs out. So I'm very sorry. Thank you for patiently waiting. And we can kind of get right back to it. So what I was really trying to say is that my prevailing philosophy is based on the observation of price. And price is a discounting mechanism. Price anticipates the news, but to me, so much of the market is perception and psychology. And really what I was getting up to, and I didn't have a chance to open up some prior emails, but a couple of weeks ago, the early part of January, there was so much bearishness that had been built up. I don't know if you remember the back end of 2022, December, it looked very negative. Just about every analyst that we listened to on TV said, first half is going to be terrible, and then the second half, we're going to rally. And so the market was very positioned offsides, very positioned in a bearish posture. And I was saying to our members all the way back in early January, I said, look, you got to be open to all possibilities. This thing is knocking on the door of a breakout here. This is the S&P, by the way. So I put up two charts. This is the S&P 500. It's the major stock index in the United States. And this is the IGV, which is an ETF that basically includes all of the big tech stocks, Microsoft, Intuit, Salesforce, etc. And they're just proxies for the overall market since technology encompasses so much. So we've been watching the S&P for the last year, effectively. I'm so afraid of this computer programming collapsing on me here. We've been watching this downtrend where every rally was then offset by a new low. And in this year, we started to change the behavior in that instead of selling off here and making a new low, this started to sneak out the other end. And so, I was saying 2 weeks ago that despite all the bearishness, despite all the anticipation of a recession and all the negative talk, the S&P was breaking out. So now we're going to have another pivotal chat by Powell tomorrow. But this is what the market is telling us. You can see that we've kind of broken out of this symmetrical triangle. And to me, the path of least resistance is still higher. We sold off on Friday. We sold off today. It looks terrible. But I have a feeling Humpty Dumpty is going to be put back together again. And by tomorrow, we might have an early sell-off. And I think that will be a buying opportunity. Now, the reason why I sold into this, and you can see that we've got this resistance area right here. So this is why we're just kind of mining this area. We broke out, we backed off, we retested this thing. And I imagine that after some tough talk tomorrow and maybe a sell-off, this will be back in an upward direction since we've broken out. And I still think we've got more to do on the upside, even if we turn around. So, again, it doesn't matter what I think. What I do is I create risk-reward relationships around price, where I try and find areas to get in where I can create a very small risk for a much bigger upside. So I'm just trying to give you kind of a bird's eye view, kind of a, from a, 12-mile, above level, you can see the IGV was going down in a downtrend. This is, again, this ETF that includes all of the tech stocks. And we had all of these reversals that were then followed by new lows. Then you can see we have this reversal here, and this is where the markets create these traps. It looks like it's going in the same kind of psychology as the previous downtrends, but all of a sudden, this one stopped a little shy and started sneaking outside the boundaries of this downtrend line. And so this is what I look at. I basically observe price. Now, the market has been very challenging for the last 6 months. The S&P back in May was about 3,900, and by January, it was still 3,900. So we've been, very spoiled by these rock and roll markets where for, all of COVID, when the central bankers were providing helicopter money, markets were going straight up. And then we got into this bear market when the Fed started to tighten. And so we basically went lower. And so it's easy to trade a directional market, to be short when the market's going down, to be long when the market's going up. It's a little bit more challenging when the market basically goes both sides of unchanged. So we have to wait patiently for these opportunities. So now you can see that the IGV, the tech sector, has started to break out above this. Now, sometimes we get these fake breakouts. There was an area on Friday, and this is what I really sold against. Where you see like old places of resistance, this is where the market sees that resistance and initially sells off, and that's what we saw on late Friday and into today. So now the question is this, bull market over, or is there still more left on the upside? And I tend to think that we still have more room on the upside. So you can see that we're trading in this very narrow channel on the IGV. We broke out. I'll look at it on the daily. And now we're, close to the low end of this channel, where I can imagine it's probably going to ricochet and bounce off of. So these markets observe very technical levels. People always say, well, can you trade technicals? Do technicals work? Meaning, does price analysis really work? Well, you can see how evenly every time price got to a certain area, it sold off. So these prices do respect these technical levels. And this is what I try and observe. And this is what I'm trying to share with you over the next couple of days, is a way of looking at the markets entirely through price. So it doesn't matter what Powell says tomorrow. We have to create risk-reward relationships based on setups in the market. So now I've gone to a daily view. Before, that was a weekly chart, which meant each one of those price bars represented 1 week in time. Now each one of these price bars represents 1 day in time. And what you'll notice is on this chart, you only have price and time. There's, no volume. There's no moving averages. There's no Bollinger Bands. There's no MACD. There's nothing on this chart but price and time. And so what I try and do is observe through the structure of the market what is going to be the likely next trajectory. So what I'm always trying to do is take a piece out of the middle of larger moves instead of trading in and out every day. And unfortunately, this is basically what we've had for the last 6 months. It's been a very kind of channel trading range market and really hasn't given us a lot of opportunity. But really what I'm trying to do is always look for a pattern. And in this case, you have what's called a head and shoulders, where you have a man and woman's left shoulder. This is the head, and this is the right shoulder. And after that head and shoulders, this is a bear pattern. So once we recognize this pattern, then we can anticipate the direction of the market. And all I'm trying to do is find these patterns and take a chunk of the market in that direction. Now, for the past couple of months, counterintuitively, while we've had all this fear talk and negative talk, and it looked like the economy was going to go off a cliff and everybody was talking about recession, I was talking to our members that, until this is taken out, I can't discount that this is a double bottom. This is the IGV, and this is what it looked like back in November. So we're already, in February, 3 months later, and we're higher than where we were in November by virtue of a bullish price pattern. Now, until this price pattern has been taken out, sometimes we see patterns in the market and it takes a while and they're taken out. We got to assume that this is still directing traffic in the market, meaning I always look for what is the governing pattern. There's always different patterns in the market. Here was a head and shoulders, which is a bear pattern here. But now we see this double bottom. So now there's the conflict. Is this the real pattern or is this the real pattern? And, sometimes it gets a little tricky to discover that. But right now, it looks like this double bottom and then this basing action, if you will, is like what we call a cup and handle. And my computer is really screwing up here, so I'm not sure what's going on here. So when we see a pattern, we always look for some kind of confirmation. And confirmation comes usually by a breach of what we call a neckline. And a neckline is simply a line that is drawn through the entire pattern. So you can see this is where we broke out. Now, typically, price behavior is such that, just like the first, pawns or the first soldiers through the gate in a war are sacrificed. Everybody gets excited on the breakout, and then you usually get some kind of retest, and then comes the real move. So you can see that last week we broke out above this pattern. Now we've come back to retest it. And if this pattern is good, it should hold and it should go back up. And if it doesn't, then, we'll look at it in another way. So this is still a market that's in a downtrend. We've had a lot of fake breakouts in the past. And the question, continuously over the last 13, 14 months, are these rallies in a bear market? This has been a long-term bear market, and you get some very big up moves in bear markets. And the question is this a rally in a bear market? Now, I'm kind of looking at another pattern here. This ascending, broadening price pattern. So sometimes we see all kinds of things. And so to my mind, it's entirely possible that we come and retest this area and then either kick up or kick back down. But the point is that I look at everything through the prism of a structure. And if I can't see something that I like, I wait for an opportunity. I wait till prices get here until I can form some kind of decision if it's going to do one thing or another. Now, as I said in my introduction, I look for patterns, and then I look for what I call my insurance day bars. An insurance day bar is what I call a key reversal, where the market makes a new high and closes on the low. Now, this is in context with a pattern. You just can't look at these reversals in a vacuum. This is when a pattern had formed, and that reversal was just confirmation of what I was looking at. And then this is a way of creating a risk-reward trade, where basically you know where to get in, you put your sell order there, and you put your stop loss here. And if you'd sold it there, you would have been in for a nice ride. So to me, these price bars, what I call my insurance day bars, tell me where to get in a trade and where my risk is. Here was another formation, and it didn't last very long, but you could have traded it. We had this double top, and you had this key reversal, made a new high, closed on the low, and then you got this move. But this is why, you can't trade these patterns in a vacuum. And this is where it gets very nuanced, where sometimes we see patterns, and then the distinction, and what's taken me a long time to recognize, is if you see this pattern in a textbook, pretty much you're going to see that kind of price action ensue. But this is real life and the real market. So what I do is I look at patterns, and I look at how does the market react to the pattern. So you can see this was a very bearish price pattern, and prices initially did fall. And my expectation was that, even if they did a retest, by the time then it should have done this. And I have a saying, if the market's not going to do one thing, meaning if it's not going to do that, it's going to do that. And so by kind of not doing what this pattern indicated, this has become what's called a busted pattern, where you can see the more prices start ignoring that pattern, then the implications of that pattern no longer hold. And basically, I would just trade it from the other side. So this is why I think that there's still more left on the upside in, this move in the S&P. So I know that probably sounds very complicated. I never know how to kind of communicate these things. I know a lot of people have been on these things and I say that every time, but I always feel like I lose people. So you can see that the S&P has been trading in this very tight channel. And this is where I would anticipate prices going back to the 40-50 area. So tomorrow, if Chairman Powell comes and he talks very tough and the market starts falling out of bed, I would be looking to take a crack at buying it there around the 40-50 area. Now, it could come to the 40-50 area and then go right through here. So again, I look at the markets and structure and then make risk reward trades around that. So things are a little bit kind of betwixt and between. So don't quite know how sometimes to adequately explain it. So I came in short the NASDAQ today. Again, just because I saw an area on the chart, and it all again comes down to price action. So I feel like I'm getting very much lost in the weeds here. So let me just kind of. So this is the triple Q ETF, which basically is the NASDAQ. You want to trade the NASDAQ up or down, you basically trade the triple Q ETF. And either you can buy or sell the triple Qs, or what I do is I buy calls. Calls are a bet on the upside and puts are a bet on the downside if you want to leverage that bet. So, and I'm sorry, I can't bring up the email. A week ago, in my weekly report, I said my objective on the triple Qs was 310. And then last week, I do something called the Boiler Room, which is a morning program where I analyze the markets. And on Wednesday, I said my target for the triple Qs was 312. Basically because there was a line that came through here. You can see what I try and do is find a number of times where the market intersects. So you can see there was a big intersect here, here, here. And then when these markets revisit these things, this is where the first level of resistance comes in. So on Wednesday, this line came in at around 312. So this is where I started buying my puts on Friday, where the market basically came to, I think, 313.84 on Thursday. And I started buying the puts at 312.85. And then on Friday, I bought some more, speculating that this was going to open lower. And you can see we've had a minor sell-off. But again, I think this is still an uptrend. You have this up channel. And then tomorrow, I can imagine you may just bang the lower end of this channel, which is around, I'd say, 298. And then I think that you're going to spring back off here. So if we sell off when Chairman Powell talks, I'm going to look to buy some call options around the 298 area. And so what I typically do is buy something forward, buy the 301 calls that expire on Friday. And, sometimes I just play around with these ranges. But what I look to do is I try and look for patterns in the market. So here is a double bottom pattern. And this pattern was more or less confirmed by also the price action. So what I do is I look at the pattern and then I look within the pattern at what I call the price action. And what I mean by the price action is when this made an all-time low for the day, by the end of the day, the buyers were in control. So that we had this double bottom with this key reversal, which then pointed in the direction that this thing wanted to go. to my mind, the markets point where they want to go. You don't have to have, a degree in economics from MIT. You don't have to have any superior IQ. The market basically points where it wants to go. And once it starts going and you want to join the trade, you look for areas in the chart. So here's another reversal where it made a new low, closed on the high, and then it took off from there. So basically, I look for patterns or trends that indicate where the direction of the market is, and then I look for ways to get in sync with the market. So the best thing is to wait for the end of the day. If you're trading intraday, it's kind of speculative. When I say, when it breaks to 298, I'm going to buy it, it's pretty speculative. The best thing to do is kind of wait till the end of the day. And if you, get a bar like this, it goes lower and then closes on the high of the day in the direction of the trend, then basically what I suggest is you put a buy stop over the high of that day and you put your stop loss there. And now you understand how to join this trade and where your risk is. And that's really the holy grail of trading, to understand where to get in a trade and how to contain your risk. So, we haven't really seen this thing play out yet. We're in a trading channel, and the best thing to do is kind of wait until you get some kind of indication as to whether this channel is going to get broken or it's going to bounce up out of here. And I think it's going to do that. So, Andreas, how do you use a trailing stop to lock a trade? So basically, what I want to do is find trades that are going to extend for moves. So for instance, if you bought it here and your stop loss was there, I would leave, a lot of room. If you think something's going to move, it's very easy for this thing to pull back to here, to 295 or what have you. So if you got here, you don't want to now put your stop loss, too close. If you think this is going to make so the art of placing a stop and trailing it, what I typically say is, since these are very volatile markets, for the past 6 months, basically you've just had this. So I've been saying to our members, take, a good portion of your trade as it comes out of the gate. Take 20% off here, take another 20% off here, and then put a, trailing stop loss on the rest. I am usually looking to try and find trades where I can find a double top like this and get into a nice trend and take a huge chunk out of the middle. That's really what my objectives are. But, this has been a very different environment. It's been a very challenging environment. You can't be long for 2 days, you can't be short for 2 days. But I do think that this thing is going to start moving that way. And if it isn't, then I'll trade it on the short side. It doesn't matter to me. So the placement of a stop loss is, I usually look for key areas. So you get in here above this key reversal, put your stop there and, let it go. Don't, be so close to bring it to unchanged. Then you get nicked out before the thing goes again. So it's a very difficult discussion as to where to put stop losses. It's really a function of the trading environment and what you think the potential for that trade is. So I do think that, if this is a bottom that, and again, I'm looking at this like a cup and handle, a double bottom, and I'm looking for a retreat here. And if it's a bottom, we should see, I think, a resumption to the upside. And if this is going to crap out, then, I'll get short. And I'm very open to both possibilities. This is still a bear market. This is still a downward trending market, but we've kind of broken cadence. And I'm getting the feeling that, we could. So this is what I do. I look at patterns and then see how does the market respond to that. So market usually doesn't end with one just move up here. It needs to consolidate that thing. So even if it's going to end, it needs to come down, re-challenge that, and then we'll have a double top, and then we can start discussing this look on the other side. So that's why I still think there's another move to come on the upside, and I'm getting the feeling that tomorrow we're going to get blitzed, when Powell speaks, and that's going to be a buying opportunity. So I'm sorry we took so much time, my computer crashed, what have you. I'm trying to think. I guess the stock that I really, like, and it looks a lot like the triple Qs, is Microsoft. MSFT, this is Microsoft. And just like the triple Qs, Microsoft came to this area. You can see this area here where there are multiple areas. You can just see multiple areas where this has hit resistance. And actually, this is actually making me even more bullish, because the more time something hits an area, the next time it's likely to go through. So I'm getting a feeling that this is it. We sold off today, we sold off on Friday, but I feel like this is a buying opportunity. And what I'm looking at is the bigger picture. I'm looking at this. So this looks like a W, which is a double bottom. And then you re-hit this. And so this is what's called an even atom bottom. When you hit an area multiple times and then you hit an area just once and bounce from there. So this is giving me the feeling that this is a significant bottoming here, and that this sell-off is a buying opportunity. So the way I would handle this thing is wait for this thing to sell off tomorrow if it does, and then put a stop loss, put a buy stop over today's high. And, let's say we sell off and then you put a buy stop here. I would simply put a stop loss here. And now you basically position yourself if it's going to move higher. And then you've got a way to handle something if it's going to move lower. So again, this is Microsoft. It's coiling. And probably the best thing to do is wait for the close tomorrow, even if it does this. Now let's say hypothetically, this is what it looks like. I would put my buy stop above the high of whatever tomorrow's range is, and I put my stop loss below the low. And then once this thing starts going, then you can start adjusting it, in the direction of the trend. But I'm trying to give you just a way and an approach of just looking at a picture. So I don't know what the earnings are. I don't know what the cash flow is. I don't know what the balance sheet is. I don't know anything about this company. All I'm looking at is a price chart, and I'm trying to make risk reward determinations. So we hit this resistance, we've come off, and basically, if you're super aggressive, you can just put a buy stop in above today's high. I would wait until, sometime if, get a sell-off. And, if you're super aggressive, you can even buy into a sell-off, because I think you'll find support. So Microsoft is something that, I'm looking at, going in to tomorrow, among other things. So Powell's going to be speaking on 2 days. And again, I think that he's going to try and talk tough. I think the market really interpreted his comments last week as very dovish. I think he's going to try and compensate for that. Say, hey, we're going harder for longer. The market's probably going to get pounded, and that probably will be a buying opportunity. But we'll see. Again, what I'm saying to you is really more speculation. What I advise is that you wait for a daily bar to appear. So we don't know what tomorrow's range is. Maybe tomorrow it opens like this and, ends up like that. So that's why I advocate to our members is to trade the daily time frame. This is a daily chart where the high and low is 1 24-hour session. So the best thing is wait till tomorrow. And if we have something like this, then you have confirmation in the direction of the trend. So here was my hypothetical bullish price pattern. And then I wait for confirmation in the form of price action. And here was that confirmation. You make a new low and you close on the high. So this is where the sellers came in, they couldn't sell it anymore. And by the end of the day, the buyers were in control. So the market tells you, the market points in the direction it wants to go. So this was 240, and you could have bought it there and taken a ride to 268. And tomorrow you may get another one of these. So these are reversals in the direction of the trend. So what I do is try and wait for the market to tell me what it wants to do. In this phase, it was in a downtrend. Now these bullish patterns started to appear that suggest that this trend may be starting to change. So now I want to get in, faced in the direction of the next shift in prices. And then I just wait for the market to tell me when the right time is. Right here, it's very ambiguous. This could be a double top. Market could go straight down. I don't think so. But the best thing is to wait for the day to, finish. If it closes on the high, sometimes I'll just, buy it on the high or wait for the next day. Hopefully, it opens a little lower. And this is where you can kind of buy something against the key reversal, knowing that's your low, you get a better price, and then it goes that way. So sorry about the computer meltdown. Are there any questions on that? And again, this is all about price action. You can see right here, just like the triple Qs, you had a head and shoulders pattern here. And then you had a very nice move lower. So these patterns precede moves. So what I look to do is I look for the market to tip itself and then get in the direction as indicated by the pattern. Now, it's very nebulous in here. This is still kind of a U-boat that's turning from a down market to an up market. And sometimes, it takes a lot of time. Gets going, fakes you out. Gets going, fakes you out. But if we understand what's really going on down here, we can use these sell-offs. And to my mind, again, if it comes in lower, my mindset is probably to start buying that sell-off. Shioma says, how do I set up the QQQ dashboard? I'm not quite sure what you mean by that. QQQ is simply a ticker symbol. So QQQ is an ETF. So you basically put triple Q in your computer and it should give you the price and the chart. It's just a ticker symbol. Are there any questions? All right, so tomorrow I'll come back and revisit the stock market a little bit. I'll also talk about gold and silver. And then on Wednesday, we can talk about currencies and FX. And what I'm trying to share with you is that you can use this price action trading analysis on any instrument. So if you're trading gold or the euro yen or IBM stock or crude oil or natural gas, it really doesn't matter. I'm just trading a picture. I'm looking for patterns. I'm looking for the market to tell me which direction it wants to go in. Sometimes there is no direction, and those are markets that I don't like to trade. I don't like to trade when a market is just chopping around and directionless. What I want to do is find a market that is picking a direction and start positioning myself in that direction. John says, I trade candles. I don't use bars, but if the candle closes above. So it's a personal choice. To me, I just see the bars very clearly. When I open a chart like this, kind of what did I not sure what happened there. You know, let me just make this just a hair darker. So when I open up a chart, I like something just to really jump out at me. If I'm having a difficult time, if I'm trying to turn my head sideways, if I'm trying to figure it out, then I know I'm confused. I like to find something where I'm not confused. I see something, I understand it, and there's either a pattern or a price action. So, you know, it's a personal choice. But to me, when I see something like this or something like this, it stands out very clearly to me. When I see these bars, you know, with Chinese candles, sometimes with, you know, the body of the candle and the what have you, it's, look, I suppose it's experience or what have you. To me, I trade bars because to me, it's very important how something closes relative to the high and low. So if I think there's an emerging bear pattern, then I wait for a certain day or days to confirm that. And so when I see this pattern and then I see this conclusive thing where they try to take it higher and they close it right on the low on this huge bar, that to me tells me that there's, you know, a lot of selling pressure. Now this thing bottoms, it makes a new low and closes on the high. Now you can't just trade these reversals in a vacuum. As I said, you know, you need to consolidate. So what this needed to do, if it was going to go up, it needed to basically consolidate itself. But this started tipping the direction. This was the all-time bottom. So you can see that this was already pointing to where that was going to go. You had to go through all this shit to get there, but that's not the point. Is that these bars point in the direction they want to go. Now, this was also the same pattern. You had a bottom, came back, you reconsolidated, but it was this bar that confirmed that this was a low. Now you could basically trade every reversal thereafter. Made a new low, close on the high, buy it. Made a new low, close on the high, buy it. Now tomorrow, if you pull back here and then end up like this, you can buy it. So it's pretty simple, actually. Trev says it makes sense. Does this make sense to you guys? Can you see visually now? And again, I'm just trading a visual. I'm not trading Powell. I'm not trading inflation. I'm not trading whether there's going to be a recession. I'm not trading whether, you know, China's going to retaliate for a balloon. I'm just looking at prices and making a simple price decision. So I'm going to buy it here and I'm going to put my stop loss there. And if I'm wrong, I'm going to go and do another trade. So this isn't about being perfect. It's about trying to manage your trades, you know, according to price. And there was an area here where usually I wait for prices to tell me, you know, where to get out. But right up here, I started to sell. I started to buy these triple Q puts because this was an area of heavy resistance. It was there and there in many areas. And I said on Wednesday or Thursday in the boiler room, I said, I'm looking for 312 on the charts. And it went to 313. Oh, shit. It went to a high of around 313.84. So when this thing was trading at 212.85, I started buying puts when it was still going up, because when you buy puts, you want to kind of puts start going down in price as the market's going higher. So it's a whole different thing. But, you know, as this was going higher, I was betting that this thing was going to come off. And so I made like double my money just on that move. Actually, a little bit more. Thanks. And so, you know, sometimes, you know, levels will tell you where, you know, you should kind of start taking profits. And if you're super aggressive, you know, you can take a little shot, but again, I didn't expect this to last for a long time. You know, we're in this very tight channel here. And I'm looking for this thing to maybe come down to this 298 area. And then to ricochet again. Christian says, do we use our local time zone or close? That's something I can't answer. I'm on East Coast time. My charts close at, well, the market closed at 4:30 p.m. in the United States. I think my currency charts close at 5 o'clock. So I'm on, Eastern time zone, and that's what I look at. All right, guys, I will see you back tomorrow. Sorry about the blackout. Francis says, I joined Mark nearly 3 months ago, and I've been making money from the get-go. He's awesome. Thanks for that, Francis. I really appreciate that endorsement. Trev says, all right. Let's see. Tamid says, it's making a lot of sense, but as I'm new, I need a better understanding. Also, as you say, you don't trade on the news. Does this mean fundamentals are less important? You can't really trade on fundamentals. The markets are really ahead of the news. And, the market started bottoming down here. And, you might see something later to validate that, but the market actually started bottoming back in October, even in the worst of times. So, in the midst of it, when it's all fearful, you can't see it. If you were trading right here, you would have heard recession, Fed, the world was really falling to an end. And you could see the technicals, people were starting to buy it. So by the time you kind of see what's going on, the moves already happened. If you're interested in some information on our programs, I put an email in the chat box. Just send my assistant Frankie an email, and he'll give you some more information on some of our programs. Thanks, Eduardo. Thanks as always. Choma says, any indicator? So no, I don't use any indicators. I just use price action, patterns and price action. So, it starts very simply with the observation that there's a bottom here and there's another bottom here. So now, to me, these markets suggest that you put in a bottom for a while. Now, bottoms can turn around. They can now make a double top and turn into another pattern. And now we could be back into it. And so, I will be, trading it as it comes. But for right now, the path of, we've come off these bottoms and we've broken out of this neckline. We pulled back, and I'm just assuming that we're going to ricochet back in the direction of the trend. And if it doesn't, I'll get short on, some kind of retest. And again, I would need to see some kind of, retest and then failure. So if I saw something like this, now I could say, okay, here's a double top. Here's the key reversal. I could test getting short here, put my stop there, and see if it's going to cough on the downside. But for right now, we're breaking out on these weekly charts. As big a bear as I was last year, and I was very, very bearish, and I still think that we could go down substantially. It just feels like there's more left in the tank here. So I like stocks like Microsoft and maybe Workday or certain stocks on this pullback to buy it. But again, you don't have to guess. Don't trade in the middle of the flurry. There's really no trade here. You have to wait for a day to then speak to you. So let's say you have a flush out tomorrow and then you see this, then you can trade. Right now, it's between support and resistance. There really is no trade. I shouldn't have even said that. Here's support, here's resistance. We're right in the middle, and it could just, be very indiscriminate in here. And so what I suggest is that you wait for a day. Let's say it goes down tomorrow. It looks like this. And then, you get a day like that. Then now the market's told you, hey, I'm ready to resume on the upside. Put your stop there, put your buy there, and then take it that way. So wait for the market to tell you. If you're trading in the middle of all the flurry, you're always going to be confused. So the market does sort it all out. And that's why I recommend you trade on the daily, not the 5-minute, 15-minute, 1 hour. The daily, the weekly, and the monthly kind of tells you how to get in sync with the bigger moves and not get, stopped out with all of the chop. Show us, how do you calculate stop loss and take profit? So it really depends on what I'm looking at and where I think it's going. So again, if I'd gotten in here, I would have put my stop loss there. Now you're in the trade. Now you wait for the next kind of setback and a way to kind of understand. I just use the price action. It is a very simple, way to say it. So what I would do is I would look for some kind of reversal and then put my stop loss underneath that. So markets end, in the same way they start. To me, even if this was going to end, it would have to end with some kind of pattern, right? It would have to come down, make a retest, and then we could say, okay, here's some double top. Markets usually don't go straight up and then straight down like that. So even if this is going to end, I would look for the signs of it ending as much as I look for the signs of this beginning. So everything begins and ends with a pattern and a price action that kind of gives you an indication where things are going to get a little bit dicey. All right. I'm going to leave it there. Otherwise I talk forever, but I'll see you back tomorrow at 4:30 Eastern time. Thanks, Dwight.
All right. See you later, Mark.